Let's go ahead and change things up just a little bit by taking a look at the supply determinants of loanable funds first. So remember, a shift in the supply curve of loanable funds occurs when a factor increases or decreases the country's willingness to save at any given interest rate. So remember, the supply side is made up of individuals like you and I. It's made up of firms and corporations and also the government themselves. So there are a few factors that we need to go ahead and take a look at, and these are all going to shift our entire supply curve either away from the origin or towards the origin. So let's go ahead and take a look at the determinants of supply. So determinants of supply of loanable funds. So of loanable funds. So here, these are all things that are going to be shifting our entire supply curve. And let's go ahead and take a look at increases in supply. And once again, if you want to go ahead and see the opposite case, just change everything to the opposite side. So here we have demand 0. We have our initial starting point. We have S0. We're at 0.8 initially. We have equilibrium interest rate R0. And then we have equilibrium loanable funds LF0. So here we have LF on the horizontal axis. We have interest rates on the vertical axis. And we want to go ahead and see what happens when we increase supply. So increases in supply. Remember, increases in supply, we shift it over to the right. We end up at point B. And what do we notice about our new equilibrium? Anytime we have an increase in supply, we're going to have a lower interest rate. Interest rates get pushed down, but we have a greater amount of loanable funds quantity right here. So LF1 right here. So now we have an increase in supply as we move from point A to point B. We are going to notice that in equilibrium, it's going to change our interest rates. So we have interest rates that are going to decrease. Interest rates decrease. And then we also know that the quantity of loanable funds is going to increase. Quantity of loanable funds increase. So here, twofold effect with our macroeconomic equilibrium as usual. And anytime, of course, we have a supply decrease, just change everything to the opposite case. So there are 5 determinants that we need to go ahead and take a look at anytime we have a supply increase. So here, let's use a little bit of intuition to build all these up. First, we take a look at economic outlook. So economic outlook. With economic outlook, do we need the economy to do really, really well or the economy to tank in order for us to go ahead and save money? Well, we're going to need to go ahead and have the economy that is tanking, so a worse economic outlook is going to cause us to go ahead and want to save more money. If we have a really good economic outlook, we're actually going to go ahead and spend or consume more money. So here, just the opposite case, when the economy is tanking, when there's some type of recession, or we believe that the economy is going to tank, then we want to go ahead and save more money to go ahead and protect ourselves, put more money into the banks. Next, we take a look at incentives to save. Incentives to save. We need to have better incentives to save, of course, in order for us to save more money, put more money into the banks. So here, if the government decides to say, hey, well, we're going to go ahead and increase the amount that you might get if you put money into the banks, will increase, if you want to go ahead and put money into your retirement accounts, say your 401k accounts, or if your former corporation says that, there's just going to be better incentives to save. You're going to go ahead and put more money into the banks. You are just more incentivized to let money go into the bank rather than just put it into your pocket or under the mattress. So anytime there's better incentives to save, either through firms or corporations or by the government, you want to go ahead and put more money in there. Next, we take a look at incomes. So incomes, obviously, the higher your income is, that means you're going to go ahead and want to save more money. Nothing too in-depth about that. However, something that is related to incomes but is different are asset prices. So asset prices are essentially the prices of any asset that you own. So your house, your stocks, your bonds, your financial assets, your yachts, paintings. So essentially, asset prices are tangible items that you own and what the prices of them are at that given moment. So what has to happen to asset prices in order for you to want to go ahead and save more? These asset prices need to be tanking or they need to be lower. So this ties into the idea of your wealth effect a little bit more. The more assets that you have, the higher the price, the wealthier you feel. So therefore, you're going to want to go ahead and consume more. But the more assets that you have and the prices tank, the less wealthy you feel. So therefore, you want to protect yourself and you want to go ahead and save more. And then finally here, the final player that comes along in terms of saving more money, putting more money into the banks, is of course going to be the government themselves. So anytime the government runs a budget surplus, they spend less money than they actually take in as tax revenue, so they save money in this instance. They're going to want to go ahead and put this extra surplus into the account that they have at the Federal Reserve, and they're going to be generating some type of interest for that. So anytime the government runs a budget surplus, that is going to encourage them to want to save as well. So here, all of these are going to be taking a look at supply increases for our loanable funds. If you want to see what happens with supply decreases as we shift the supply curve over towards the origin, just change everything that you see here to the opposite case, change that sign. And of course, that's going to cause a different change in our macroeconomic equilibrium. So once again, these are the only things that are going to be affecting supply. So don't confuse it on the demand side, even though we have the entities appearing on both sides of the market. So just be a little bit careful in this case. We'll build up the demand side of the market with the demand determinants in the next video.